Okay, we'll start. So we'll go to the nature and contribution on the nature of contribution and its calculation. So yeah, when we talk about the nature of contribution and its calculation, we're basically talking about the purpose of contribution. Why do we have to use contribution? Why do businesses use contribution? So these are the purposes of contribution. Are you with me? So the first one, so it can be used to calculate, okay, yeah, it can be used to calculate the break-even level of output. So when I talk about the break-even level of output, the formula is fixed cost divided by your contribution. If you want, what we are talking about is if you need to know the level of output you need to produce to make your break-even. What is break-even? Break-even means your total revenue equals to your total cost. Okay. That is what break-even is. So what is the level of output that you have to produce to reach break-even? That is what we mean by break-even level of output. So it has its own formula. And the formula is fixed cost divided by your contribution. Remember your contribution. How do you get your contribution? Your total revenue minus your total variable cost. Yeah. So that means when you're talking about your break-even, it will be fixed cost divided by total revenue minus total variable cost. Is it clear? Yeah. So that's the first purpose of contribution. The second one, it can help to calculate the amount of profit made by a business. So with contribution, you'll be able, at least you know that contribution, the money, when you talk about contribution, it means that you have taken away your variable cost. So the amount of money that is left, you are able to get your fixed cost from it. And if it's still excess, you'll be able to calculate your profit from it. Do you understand what I'm saying here? Yeah. As soon as you cover your variable cost, it means that the amount of money left will be for fixed cost and your profit. So it means that with contribution, it allows you to be able to calculate your profit as a business. I think it's clear. Yeah. The third one, calculate the amount that needs to be sold to reach a specific profit target. So what does this imply? It implies that as a business, you'll be able to know the amount of money you need to sell. If, okay, your profit target is 5,000. So with your contribution, you'll be able to know, oh, if our targeted profit is 5,000, it means we have to sell, our contribution have to exceed, our variable cost must exceed that amount. You know, your variable cost is what you have covered with the amount of money when you sell. So your total revenue, you've taken away your variable cost. That is what is left is your contribution. So if you have a target, it means you have to start thinking about the price at which you'll be able to sell. Yeah. The price at which you'll be able to sell to exceed your variable cost. Do you understand? Because if you cannot exceed your variable cost, then you cannot make profit. Do you understand? Yeah. First, you have to cover your variable cost. What is left is your contribution. Now that you have your contribution should make up for your fixed cost and your profit. So if you have as a business, you have a target of profit, it means you have to start thinking about contribution pricing. We'll get there. When we get there, I will explain further. So you have to start thinking about the price at which you can sell, that will exceed the price at which you can give to your customers, that will exceed the variable cost per unit. Is it clear? Yes. The third one, help a business to decide which order to accept when faced with a choice. So with contribution, it allows you to understand which order you have to pay for or which order you have to accept, if it is order A or B or C, based on the cost. You know, before you make a choice, you would have to think about the cost of the production. Yes or no? Yeah. So what the fourth one is saying is that based on the fact that you have different options to make, different choices to make from, then you start thinking about the one that has the lowest cost. So contribution allows you to make a choice when you are faced with making a choice. And the last one, contribution helps business decide what price to charge for a product. Yeah, like I told you earlier, with contribution, you'll be able to know, okay, oh, this is what our contribution will be. Then what is the price that we have to charge, maybe to reach a profit? Or what is the price we have to charge to be able to exceed the variable cost? So with contribution, you'll be able to know the profit that you have to target. 2, you'll be able to calculate your profit. 3, you'll be able to know the price you have to charge for your product. And 4, you'll be able to make, whenever you are faced with making a choice, contribution can help you to decide on that choice. Do you have any question about that?
No.
Then we go to the interpretation now. So we have interpreting contribution. Are you there?
Yes.
Interpreting contribution. So when I talk about interpreting contribution, what does that imply? We're talking about different ways in which we have to start thinking when it comes to contribution. But before then, okay, yes. So for interpreting contribution, we're going to start with the contribution margin ratio. So when you talk about contribution margin ratio, it's the same as your gross profit margin ratio. Are you with me?
Yes.
Contribution margin ratio is the same as what? Gross profit margin ratio. And when you're talking about your gross profit ratio, it means your gross profit divided by your sales multiplied by 100, multiplied by 100. Are you with me?
Yes.
So for contribution margin ratio, it will be what? Your total contribution divided by your total revenue multiplied by 100. Because your gross profit ratio, gross profit margin ratio is gross profit divided by your total revenue multiplied by 100. So here, as a firm, you can calculate your contribution margin ratio. And how do you calculate that? Your total contribution, which is what? Total revenue minus your total variable cost divided by your total revenue times 100. That's how you calculate your contribution margin ratio or your gross profit margin ratio. Is it clear?
Yes, sir.
So we go to, that's about contribution margin ratio. Then we go down to contribution fixed cost, variable cost, and profit. Are you there? Page 100.
Yes.
So for contribution, we already know the formula for contribution. It is your total revenue minus your total variable cost, right? That is sorted. Then for your fixed cost, it's always constant. You should always have your fixed cost. And what are fixed costs? Costs that does not change, even if the level of output changes. So it's always constant. So irrespective of whatever choice you are making, the fixed costs are always the same. I think you understand what the fixed cost is now.
Yeah.
It is constant. Then we go to your total variable cost. For your total variable cost, I told you already, it is your variable cost per unit multiplied by the units sold. Variable cost per unit multiplied by the units sold. I think that is clear.
Yes.
Then how do you calculate for your profit? Your profit is your total revenue minus your total cost. So how do you get your profit? It will be your total revenue, which is price multiplied by the quantity, minus your total cost. Your total cost will be what? Your fixed cost plus your total variable cost. The fixed cost is constant,
Okay.
plus your total variable cost, which is what? Variable cost multiplied by the unit sold. So that is how you get your profit. So if you have different options to choose from, or different order to choose from, what do you have to calculate? For the profit. And how do you calculate your profit? Your total revenue minus your total cost. And you would have gotten your contribution because your contribution will be separated from your variable cost. It means that you've covered your variable cost.
Okay. Yeah.
It means you have covered your variable cost. Then what is left is your contribution. So what do you use your contribution for when you want to calculate profit? You use it to calculate your contribution margin ratio, which is your total contribution divided by your total revenue multiplied by 100. But if you are calculating your profit, it is your total revenue minus your total cost. Do you have any question about that?
No.
So we go to contribution and decision making. Are you there?
Yes.
Contribution and decision making. Yeah, there's contribution already. We already know that. Contribution means that we have covered our variable cost. So what decisions can we make? We have two decisions to make. It is decision about the cost and decision about the price at which we have to sell. Decision about cost, decision about the price we have to sell. So decision about cost is what we call contribution costing. Are you there?
Yes.
So for contribution costing, what does that imply? I wrote, this is the use of contribution to help make decisions based on cost, such as which order to accept. Is it order A to accept or order B? In terms of the cost of, in terms of the variable cost of order A or the variable cost of order B. because the fixed cost is always there, it's constant. So we use contribution costing to take a decision when it's based on variable cost, when it's based on the cost of each product. Do you have any question about that?
No.
So that is what contribution costing will help. It is, look at the table here, it said the order, the variable cost, the price per unit. So you check the order. So if you are selling for $35, if each one is 35, then you have to sell, the total revenue here will be 35 multiplied by 5,000, right?
Yes.
So whatever it gives you, you get your total variable cost, which is 20 multiplied by 5,000. So your TR, which is 35 multiplied by 5,000 minus your TVC, will give you your profit, will give you your contribution. So because we need to know your total variable cost. Your total variable cost will be 20 multiplied by 5,000, and your total revenue will be 35 multiplied by 5,000. So this minus that will give you your contribution. Do you understand?
Yeah.
TR minus TVC gives you your contribution. I think you understand how to get your contribution here. 35 multiplied by 5,000 is our total revenue. Then 20 multiplied by 5,000 is our total variable cost. So our total revenue minus your total variable cost gives you your contribution for that order. I think it's clear, right?
Yes.
Great. So that's how we do about that. Then we go to contribution pricing. So for contribution pricing, what does that imply? We are thinking about the price at which we have to charge our product. So why do businesses think about contribution pricing? They want to charge a price that will exceed the variable cost. Do you understand? That's why we talk about, that's why when we have to use contribution pricing. So here I wrote, this is a pricing strategy that involves setting a price that exceeds the value of the variable cost per unit. So you are setting the price. If the variable cost per unit is 5, you are thinking of setting a price for 7 or 6. That means you are thinking about, you are using contribution pricing. That means you want to set a price that exceeds your variable cost. But when you are thinking about contribution costing, you are thinking about the cost of production in terms of the variable cost. You are thinking about each cost. Which one is more preferable out of the variable cost? That is contribution costing. But when you're thinking about contribution pricing, it means you want to charge a price. You want to sell at a price that will exceed the variable cost. Do you have any question about that?
No.
I think you'll be able to do the activity too now.